Hi, this is Nick Munns with Growth Management Group, and we specialize in helping companies and business owners across the country with specialized tax incentives and tax credits. And we've been around for about 10 years. We're one of the nation's leading full-service consulting companies doing this. We've helped business owners and companies in excess of over $500 million to recoup in tax credits and tax incentives. Some of the services that we offer, a completion of cost segregation studies, property tax recovery, energy tax incentive audits, hiring incentives, manufacturing tax credit studies, again yielding over about $500 million. And some of the industries that we serve: commercial property owners, manufacturers, employers, automotive, hotels, medical, restaurants, funeral homes, and many other industries, just to note a few. You can see my picture here. But one of the things that we want to talk about today is one of our services, as I'm going to pull up another screen here, is cost segregation. And many people are not familiar with what that is. And basically, as you see the screen here, and this is what is available to a lot of different companies, as you see here on the side: Holiday Inns, different hotels, manufacturers, automotive dealerships. But basically what it is, it's an in-depth analysis of specialized incentives for these property owners. And who would qualify? Well, if you notice here, commercial buildings that are purchased or constructed or renovated in the past 20 years in excess of over $500,000, or with property taxes in excess of $50,000. I'd like to just interject something here, because a lot of the business owners are misled a little bit. They think that this will only work for newer buildings, and that is absolutely not true. Any building, again, within the last 20 years. Now, if it's over 20 years and there's been no renovations, well, then maybe you might not have that much benefit. But within the last 20 years, renovated or built or purchased over $500,000. How much can a person get? This is kind of exciting, because you notice here at the bottom it says the average tax savings is about $75,000 for every $1 million purchased price or construction or renovation. Now, you notice here what happens is that a building or a building owner, they're allowed to depreciate their property over 29 years. And so that's what happens, is they can, okay, let's stop now. So what this slide here you're looking at is that typically a business will be able to depreciate some of their building or the internal things in there. Man, can I pause this? Now, typically what happens is a building owner is allowed to depreciate the building and the internal contents over about 29 years, or 39, actually 39 years. Okay. Typically what a business owner is able to do is they're allowed to depreciate over 39 years the building and the contents. But because of the IRS, the code allowing a person, they can reclassify the personal property, and so it can be depreciated over a much shorter time in buckets of either 5, 7, or 15 years. So what are some of the benefits to a business owner? Well, you notice here, increased cash flow. It's always better to have cash now, isn't it? And you think of the time value of money. Simply put, your dollar's worth more today than it will be. And also, because of the increased depreciation, it leads to paying taxes at the capital gains rate as opposed to ordinary income rate. So since capital gains rates are likely much lower than the investor's income tax rate, they would benefit from an accelerated depreciation. And by the way, you're still allowed to depreciate the bulk of the building and the contents over the 39 years. You're just allowed to accelerate some of it and get some money up front. There's also a catch-up depreciation time. So if you have not completed a cost segregation study on your property, that you've held for a period of time, the IRS will allow you to complete that and catch up some of the missed accelerated depreciation. So that's a benefit. So you'll notice here you can also free up money for investments. It also minimizes your taxes. Now we're looking at some case studies here. You notice this is a huge grocery store chain. There's savings of $3 million. Here's a couple hotels, $630,000, $950,000 for a Holiday Inn. Here's a manufacturing company, savings of $1 million, convenience store, $73,000, and a dermatology office of $89,000. So basically, we won't go through this much, but if you wanted to see if you would qualify, all it would take is about 10 or 15 minutes on the phone with one of the engineers back at our home office, and they will tell you very quickly whether you qualify and approximately how much you might be able to receive in these tax incentives. Now, I just want to mention one thing too, that there's a lot of misconceptions about cost segregation. Again, a lot of CPAs will think that you can only do this on a new building or a new renovation. Again, that's absolutely not true. The first sentence in the IRS Cost Segregation Audit Techniques Guide, Chapter 6, Point 2 reads, "A taxpayer may conduct a cost segregation study on used property and then recompute its depreciation deduction for prior years." So that's just a little bit. We're going to have more on some other tax incentives like R&D, tax credits, whatnot in the future. But if you'd like to call, we've got our number on the screen. If you'd like to give us a call or email us, we'd be happy to set up a time, 10 or 15 minutes. And by the way, there's no obligation and there's no cost involved. If we do a study and we can't find any savings for you, then there's absolutely no obligation, no cost. So please give us a call. We look forward to talking to you.